Jim likes to go to the local racetrack and bet on the horses. His favorite horse is a 2-year-old thoroughbred named Old Betsy. Anytime Jim bets on Old Betsy, he has the opportunity to win or lose. Consequently, he could experience either a loss or gain on his money. The risk he is taking on each race, therefore, is speculative.
In an attempt to minimize her getting ready time, Veronica decides to apply makeup while driving in the high occupancy vehicle lane on her way to work. She rear-ends a car in front of her, causing damage to both vehicles. The application of makeup while driving is an example of a moral hazard, or her attitude about safety, and the collision with the other vehicle is the peril causing damage or loss.
When an insurance company issues a policy on a 35-year-old male, the company really has no way of knowing or accurately predicting when he will die. However, the law of large numbers looks at a large group of similar risks and makes some conclusions based on statistics of past losses. This allows the insurance company to have a general idea as to the predicted time of death for this type of insured and set the premiums accordingly.
Adverse selection can be described in terms of poorer or substandard risk individuals lining up first to purchase insurance. These individuals want to limit their personal exposure to the financial consequences of an unexpected loss, so they transfer this potential loss to the insurance companies. This causes the increase in the adverse selection for the insurer. It takes the collective efforts of all participants in the underwriting process to reduce adverse selection as much as possible.
An insurance contract is aleatory in nature, which means there is an uneven exchange of values. For instance, Bob purchases a $75,000 whole life policy in January. His monthly premium is $100. In March, after paying only 2 months' premium, or $200 total, he is tragically killed in a skiing accident. Bob's beneficiary will receive $75,000, a mere $200 in exchange for $75,000. That's definitely not equal.
Barney and Wilma own a $350,000 life insurance policy. When Barney unexpectedly loses his job, they are forced to cancel that policy. Barney and Wilma notify the insurance company and request their policy to be canceled. The insurance company may not file legal actions against Barney and Wilma for canceling the policy. On the flip side, let's assume that Barney and Wilma continue their policy in force and make premium payments. When Barney is suddenly killed in a hunting accident, the company cannot simply refuse to pay the death benefit. As long as the premiums are current, the named beneficiary has legal recourse if the company refuses to pay the death benefit.
The principle of indemnity is the base for all insurance contracts. Insurance restores the insured or the beneficiary to the same financial position as prior to loss. How much the insured or the beneficiaries are paid is determined by how much they have lost. As part of the application process for his new life insurance policy, Herman needed to answer an extensive list of questions about his medical history. When asked if he had ever been treated for or diagnosed with any form of cancer or tumor, he truthfully answered no. Herman was accepted as a standard risk and the policy was issued. 2 weeks later, during a routine doctor's exam, it was discovered that he had an advanced form of cancer. The insurance policy will remain in place since Herman's answer on the insurance application regarding cancer would be perfectly acceptable as a representation and not a warranty.
June applicant is applying for a life insurance policy. When asked by the agent if she had seen a physician during the past 3 years, June answered yes. She stated that she had seen a dermatologist in the past 36 months. This statement was true. June had also seen a cardiologist during that same 3-year period, but she omitted that fact on her insurance application. That would be concealment.
Joe Cool owns a health insurance policy with a monthly premium. His premiums are due on the 1st of each month. For the past 18 months, Joe has paid his premiums on the 12th of each month. During the same 18-month period, the insurer has accepted the late payment of premium without any penalty. The insurer has waived its right to accept payment on the 1st of each month. The next month, Joe plans to pay his premium on the 12th. Joe, however, has a loss on the 9th for which he files a claim. The insurer is estopped, a legal consequence of a waiver, from denying a claim due to the premium not being paid on the 1st of the month because it had accepted the payment on the 12th for 18 months. Craig fails to stop for a red light and causes an accident, injuring another driver. The colliding cars also knock down a utility pole, resulting in a power outage. The element of proximate cause indicates that Craig has, in fact, caused the injuries to the other driver, damage to the pole, and the power outage. Had it not been for his negligence, the events that followed would not have happened.
Matt likes to race his car in illegal street races. One day, Matt's friend Sean asked to come along for the race. Matt warned Sean that it can be dangerous, but Sean still wanted to ride along. Unfortunately, Matt lost control of his car in the race and crashed it into a wall. Matt and Sean were both injured. A couple of weeks later, Sean decided to take Matt to court to recover damages for his injuries. He accused Matt of negligent driving, but Matt argued that Sean was fully aware of the dangers when he made the decision to ride in the car. The judge agreed that Sean assumed the risk when he decided to ride in Matt's car even after the warnings of danger, and declared that Matt was not legally liable for Sean's injuries.
Hans Buck is a champion bodybuilder and a home remodeler. Due to his muscle mass, Hans's weight is rather high. He has trouble finding ladders that will adequately support his weight. One day, Hans sees an ad for Few Breaks equipment, which claims its ladders can support up to 500 pounds. Hans buys the advertised ladder and sets it up against his house to paint the trim on the roof. When he got to the upper half of the ladder, it collapsed. Hans broke his leg in the fall. Hans sues Few Breaks equipment for a defective product. He shows the judge the broken ladder and proof that he doesn't weigh 500 pounds. The judge rules that in compliance with the strict liability provision, Few Breaks equipment is liable for Hans's medical expenses and lost wages. As Tina is leaving a store, she sees a pickup truck back into her car. While the pickup drives away, she writes down the license plate number. Tina contacts her insurance company and files a claim. She also provides the insurance company the license plate information. After the required deductible is satisfied, the insurance policy pays for Tina's car repairs. The insurance company will work with the police department to locate the driver of the pickup and subrogate against his insurance company to collect the money they spent repairing Tina's car. In giving subrogative rights to the insurance company, Tina also waives the right to personally pursue the other party for damages. The following are examples of exclusions from a property policy: earth movement and water damage. Property policy exclusions are earth movement caused by earthquake, mud flow, or volcanic eruption. Water damage exclusions are flood and subsurface water, water that backs up through sewers and drains or overflows from a sump pump, or water below ground that seeps through basement walls. Perry and Margaret are neighbors and both have an HO2 policy insuring their homes. Perry left a window open during a thunderstorm and the wind blew the rain through the window, damaging his carpeting and hardwood floors. The wind also blew off a portion of Margaret's roof, allowing the rain to enter and damage her carpeting and hardwood floors. Under the HO2 policies, damage to Margaret's house is covered while Perry's is not because the opening to Perry's house was not caused by the storm.
Abigail is a wealthy retiree who likes to travel extensively. During one of her European trips, she and her maid were staying in a villa in the Mediterranean when a fire broke out and destroyed clothing belonging to Abigail and her maid. The HO6 policy will cover the entire loss up to its limit because personal property is covered anywhere in the world. The maid's property will also be covered since at the time of the loss, she was in a residence occupied by the insured.
Lisa's 100-year-old home boasts plaster walls, cornice boards, crown molding, and wide plank hardwood floors throughout. Due to its age and special methods of construction, the home is only eligible for coverage under an HO8 policy. Lisa has a kitchen fire caused by the electrical system, resulting in damage to the floor, walls, and ceiling. Since an HO8 policy is written on a repair cost or functional replacement basis, the insurer can authorize repairs to the walls and ceiling using sheetrock instead of plaster because it is comparatively cost prohibitive. The repairs to the floor may need to be done with narrow plank wood because wide plank is scarce and expensive. This means the floor may not match throughout the kitchen. If Lisa wants the flooring to match, she will be responsible for the cost of replacing the rest of the floor. Brandon and Lakeisha live in their dwelling with their 2 young children and a foster child under the age of 21. Their son has a pet boa constrictor that they leave with a neighbor when they go on vacation. The whole family is insured under Brandon's homeowner's policy as relatives and residents in the care of the insured. The neighbor is also considered an insured under the same policy's liability coverage as a person responsible for animals owned by the insured. When vandals spray painted his garage, Mason promptly notified his insurance company. When vandals stole a $1,000 bicycle from a neighbor's garage, the neighbor did the same thing, promptly notified his insurance company, but no one else. Mason's homeowner's policy will pay for the damage by the vandals. The neighbor's insurance policy will not pay for the theft of the bicycle because where theft is involved, the policy requires that the insured notify the police as well as the insurance company. Adrian's house has a replacement value of $300,000, and she has it insured for $250,000. Wind damage to her roof will cost $12,000 to repair. Since Adrian's insurance is at least 80% of the replacement value of her house, her homeowner's policy will pay the loss in full. Mitchell's house has a replacement value of $300,000, but he only insures it for $150,000. The damage to his roof is also assessed at $12,000. The required amount of insurance is at least 80% of the property's replacement value, or $240,000. Since Mitchell's insurance limit is less than 80% of the replacement value at 62.5%, his insurance company will only pay a proportionate amount of the loss, or $7,500 in this case.
Ted's mother-in-law broke her hip when she tripped and fell down some steps in his house. Her medical and therapy bills came to $1,000 a year for 4 years. Although Ted's medical expense coverage in his homeowner's policy had a $5,000 limit, the policy will only pay for $3,000 of his mother-in-law's medical bills because medical expense coverage is limited to 3 years from the date of the accident. If his mother-in-law wants to recover the rest of her loss from Ted, she will have to file a suit against him.
Sanderson Springs is a newly incorporated community that has been developed on what was once an unpopulated area in the central floodplain. The city planners have worked with hydrostatic engineers to build water drainage systems that will provide flood protection to those families who build in that area. The community has applied for the National Flood Insurance Program and is awaiting final approval. In the interim, any real estate property and its contents will be covered by the Federal Emergency Flood Insurance Program until the regular program for which they applied becomes available. When that happens, property owners will be required to purchase flood insurance coverage as part of the mortgage loan process. Jeremy rear-ends a school bus carrying children. The bus driver and 2 children are seriously injured. The bus driver's injuries amount to $280,000 in medical bills. One of the children has $180,000 in medical expenses, and the other child has $250,000 in medical expenses. The school bus sustains damages for the amount of $22,000. Jeremy's auto insurance policy provides 100, 300, 100 liability coverage. The policy will pay $100,000 toward each of the 3 injured parties and will pay for the damages to the bus. But what about the rest of the medical bills? Jeremy also has an umbrella policy that adds $1 million coverage to the existing policy. This gives Jeremy $1,300,000 bodily injury coverage, and the policy can pay the rest of the medical expenses. If Jeremy did not have an umbrella policy, the bus driver and parents of the injured children could sue him for the balance of the medical expenses.
When Wilson sold his sporting goods business, he was convinced that the rights under the store's insurance policy would automatically go to the buyer. When the buyer later submitted a claim to the insurer, it was denied. The basis for the denial was that the transfer of rights and duties condition requires the written consent of the insurer for an assignment to be effective.
The insured purchased business income coverage with a limit of $120,000 and a monthly limit of indemnity of 25%, or 1/4. The most the insurer will pay in each consecutive 30-day period is $30,000, or 1/4 of $120,000. If the insured's actual loss was only $20,000 during one of these periods, $20,000 would be all the insurer would be obligated to pay. If the insured's actual loss during any 1-month period is less than the percentage amount, The insurer is only obligated to pay for the actual amount of loss.
A heavily loaded truck crossing a covered bridge causes the bridge to collapse. This would be considered an accident. A heavily loaded truck crosses a covered bridge 7 times without incident. On the 8th trip, the bridge, weakened by the previous 7 trips, collapses. This would be considered an occurrence.
Scaffolding on the outside of the insured's building collapsed and seriously injured Tom, a pedestrian. Tom sued the insured for his personal injuries. Tom's family sued the insured for the loss of family support as a result of Tom's injuries. Tom's employer sued the business for the loss of Tom's services. It isn't necessary for the claimant to be directly injured by the insured's negligence. All of these claims will be covered by the Commercial General Liability form.
Suspecting a customer of shoplifting, an Ace Mercantile employee refuses to let the customer leave the store. The employee, and his employer by extension, may be guilty of the tort of unlawful detention if it turns out that the customer is innocent. Wanting to check how well the tenant was maintaining the leased premises, the landlord let himself into the apartment one day when the tenant was away. In the absence of a provision in the lease to the contrary, entrance onto leased property without the tenant's permission is an example of invasion of privacy.
While on an errand for his employer, Wallace accidentally bumps into an elderly lady, knocking her to the ground. While the employer's bodily injury coverage will pay for any liability the employer may have as a result of Wallace's negligence, the policy will also pay for the victim's medical bills up to the policy limits without regard to liability. Note that this coverage applies regardless of whether the accident occurs on or off the insured's premises, as long as it arises out of the insured's operations.
Adam has an insured apple orchard that has been struck by a hailstorm which killed many of the trees. However, since crop insurance provides coverage only for crops themselves, it would only pay for the loss of the apples and not for the destruction of the apple trees. Coverage for the trees would be written into a farm policy as a separate line of coverage. Midwestern Produce Incorporated is a major supplier of corn and wheat throughout the Midwest. The company purchased a crop insurance policy on April 10th to cover a new field for corn production. Although the field was planted with predominantly corn, Midwestern also included soybeans covering 25% of the acreage, but did not inform the insurer of this. On May 14th, a hailstorm devastated over 30% of the corn crop and 75% of the soybean crop. Midwestern notified its insurer of the loss, but the insurer denied the part of the claim covering soybeans since Midwestern failed to mention that such crops would be planted in that location. Central Plains Cooperative purchased a crop insurance policy on April 10th to cover a field for corn production which had an existing stand crop of corn. On April 12th, a hailstorm devastated over 60% of the crop. Central Plains notified its insurer of the loss 1 week later and requested a refund of premiums paid. The insurer denied the claim since Central Plains failed to notify the insurer within the 72-hour waiting period as stated in the policy. When the applicant fails to notify the insurer within 72 hours, the right to return premium is automatically forfeited. If this had been a new field, Central Plains would have been entitled to a cancellation with refund of premiums, since the policy would not be considered in force until the stand crop had been established. Charles Sawyer has a crop policy that is written on a percentage plan at $1,000 per acre for his wheat crop. A heavy thunderstorm with hail damaged 50% of the plants, so the policy will pay $500 for each damaged acre. Had Charles purchased a full value crop policy, his claim would have been adjusted based on his expected crop value at harvest, as opposed to the average crop value for his area. Delta Pride is a peanut producer in a fertile valley region. Delta took out a yield policy with its insurer to safeguard itself against possible losses due to poor production levels in many of its fields. Under the policy, Delta Pride is protected for up to 75% of normal yield for its operations. If this year Delta's production falls to 50% of normal historical yield, the insurer will supplement the compensation Delta receives from the crop sales by the additional 25% that would have normally been earned if the crops were produced. The remaining 25% loss must be considered the inherent risk of farming operations for Delta Pride. Mercer's men's clothing store decided to remodel its interior and had all furnishing and contents removed. Unfortunately, the manufacturer's plant delayed the delivery of the new furnishings for a couple of months. After the building had been empty for 60 days, teenagers broke in, spray-painted the walls, and left a faucet running which caused water damage to the floors. Would the business owner's policy covering the store pay for the loss? The answer is yes. Although the building had been empty for more than 60 days, the vacancy clause does not apply in this case. The building was not vacant, it was unoccupied. In order to be considered vacant, there would have to be no intent on the part of the insured to return. 5 weeks after hiring Tio, Ansel learned that he lied on his employment application about why he, Tio, left his prior employment. 2 weeks after that, Ansel discovered that Tio had been stealing regularly from the cash box. Ansel fired Tio and submitted a claim to his business owner's policy. The policy will pay for any loss that he can prove up to the date that he learned about Tio's lie on the employment application. However, the policy will not cover losses that occurred after Ansel learned about his employee's dishonesty. Employee dishonest exclusion does not require that the previous act be a theft, only that it is dishonest.
Sherlock Shoe is a tenant in Watterson's building. The store is insured with a business owner's policy with $100,000 Section 2 limits, with per-person medical payments not to exceed $10,000. A clerk, smoking in the stockroom, dropped a match into some waste paper. A fire started and quickly spread to the rest of the store before the sprinkler system could extinguish it. One customer in the store suffered from smoke inhalation, and another sustained third-degree burns. Not including fire damage to Sherlock's property, losses from this event were estimated at $80,000 for damage to the building, $10,000 for injuries to customer 1, $12,000 for injuries to customer 2. Sherlock's business owner's policy will pay $10,000 to each customer for medical expenses and $80,000 for property damage. These payments reach the Section 2 limit of $100,000, leaving $2,000 of medical expenses for Sherlock to cover on its own.
Jason's Explorer's outing is sued when climbing equipment they sold malfunctions and a climber is seriously injured. Jason's business owner's policy has $500,000 liability limits. The injured climber wins a judgment against the business for $400,000. The claimant's wife also sues for loss of consortium and wins a $200,000 judgment. How much will Jason's policy pay? The answer is the policy limit, or $500,000. The limit is not increased by the number of claimants, but rather applies per accident. Northwest Coastal Shipping Company suffered losses due to a severe storm that occurred while one of its vessels was on the open waters en route from Anchorage, Alaska. The cargo contained 500,000 crabs, which were lost when the crew threw them overboard to save the vessel from sinking and themselves from drowning. Additional cargo included gold bullion and industrial machinery. According to the general average rule, the owner of the ship, the owner of the gold bullion, and the owner of the machinery must share in the payment of the losses suffered by the owner of the crabs. The amount of liability is in proportion to the amount of benefit each gained based on their property being saved from loss. Viking Coastal Shipping Company suffered losses due to a mechanical failure that occurred while one of its vessels ran aground en route to Anchorage, Alaska. The owner notified the insurer and then hired a local shipbuilder, All Seas Incorporated, to rescue the vessel and make repairs so that the ship could continue its journey. When Viking filed the claim for this loss, the insurer denied the claim, stating that they had informed all policyholders that all repairs must be with an approved company, and that All Seas was not an approved company. According to the provisions of a hull policy, the underwriter has the authority to veto a repair facility and to decide where the vessel shall proceed for repairs. The latest model Ferrari was being transported by sea on a special order from Italy. The owner took out a cargo policy to insure the vehicle during its journey. The policy limit for the car's value was set at $200,000. Due to a massive water leak in one zone of the ship, the car's exterior paint and interior compartments were seriously damaged. The cost of transporting and repairing the car with its original manufacturer is estimated at $220,000, which exceeds the value of the car itself by 10%. The insurer would consider this a constructive total loss, since the cost of repairs exceeds the policy limits for agreed value. Seabairn Enterprises operates a fleet of cargo vessels in the Pacific region. During an adventure in the early spring, one of their ships suffered damage to its cargo due to a delay in the harbor of destination. Under the cargo coverage policy, since it is written with a warehouse-to-warehouse clause, the cargo is insured until it is delivered to its final destination. This means that Seabairn will not be liable for replacing cargo that has spoiled because of the delay.
Bob Wilcox, a civilian contractor, and Sam Sneed, a military officer, are injured in the same accident while working on Andersen Air Force Base. However, only Bob will be covered by the Defense Base Act, since Sam is separately covered by the Military Compensation Program.
Ben Hurt, an employee for Midwest Manufacturing, suffered an injury while performing his duties at his employer's assembly plant. Ben has been in treatment for the injuries for the last 45 days. Therefore, the disability has lasted for over 3 weeks. Ben is therefore entitled to receive benefits at the scheduled rate for his injury, which are retroactive back to the initial injury 45 days ago. Benefits will be paid retroactive to the beginning of a disability if the disability lasts for more than 3 weeks. Patterson Steel, an industrial employer in the steel manufacturing business, fails to provide safety boots to its employees following a retooling of the plant. Consequently, several employees suffer foot and toe injuries due to falling debris. Additionally, employees have filed a grievance with the steelworkers local, stating that they were never adequately trained in the operations of the new equipment installed during the retooling of the plant. Employees may sue Patterson not only for the medical treatment necessary to heal their injuries, but may also recover additional compensation for the pain and suffering associated with their injuries. While the medical treatment will be covered by Patterson's workers' compensation policy, the additional compensation will be paid directly by Patterson. Workers' compensation does not cover monetary penalties incurred by the employer as a result of its negligence. Allied Sign and Signal, a road sign and signal company, has been in business for over 30 years. During that time, Allied has grown from 12 employees to over 100 employees. Consequently, the company's need for workers' compensation and employers' liability coverage has grown along with the employee base. Allied has one employer's liability policy with Southwest Risk Management, a regional carrier that offers half as much benefit as the employer's liability policy written by American Surety, a national carrier. If the policy with Southwest Risk has a limit of $500,000 and the policy with American Surety has a limit of $1 million, the amount that each policy contributes to a loss is determined by each policy's share of the total available benefit, or $1,500,000. Since Southwest Risk's policy covers 33% of the total benefit, that policy would pay for 33% of a loss. Likewise, American Surety's policy covers 67% of the total benefit, so the policy would cover 67% of a loss.
Steve's Auto Detailing has 12 locations across the state in which the company is domiciled. The company has been in business for 10 years, and during that time has made 17 workers' compensation claims. Great Plains Risk, Steve's insurance carrier, wrote the current policy 11 months ago and used an experience rating factor to calculate the annual premium based on Steve's claims history over the past 5 years. Since Steve did not make a workers' compensation claim for this policy period, Great Plains gave Steve's business a rating credit towards next year's policy premium computation. Steve will pay a lower premium this year than he paid last year for the same level of benefit protection.
Alan is a licensed insurance agent who represents ABC Insurance Company. The sign on the window of his office reads, ABC Insurance Company, Alan, Insurance Agent. If Alan performs duties that are not specifically named in the contract he has with ABC Insurance, but that are necessary in order for him to transact the business of insurance, he is exercising his implied authority. While Alan's contract does not write out every action he might perform while working with ABC Insurance, the very fact that there is a contract implies that he has been granted the authority to act in the company's best interest. Mrs. Smiley sent her teenage son Spencer to a grocery store. She gave him $40 and a list of things to buy. Spencer brought back the groceries and gave his mother back the money that he didn't use, $10 in change. If this was a mutual company, the $10 would be considered a dividend or a return of unused premium. Albert buys a house that has faulty wiring, which starts a small fire in the kitchen and causes $2,500 in damages. 2 weeks later, a thunderstorm starts a fire in the attic, causing another $10,000 worth of damage. Albert submits a claim for $12,500 to his insurance company. 30 days later, the insurance company sends Albert a notice detailing that it will accept $10,000 of the claim for the storm damage, but will deny the $2,500 caused by a non-related incident. Mary buys a used car with a crumpled bumper. After a minor fender bender, Mary submits a claim for the damages from the accident, including the damage to the bumper. Her insurance company sends her a letter denying the claim. The letter must also alert Mary that she has the right to have the California Department of Insurance review her claim and include the contact information for the department that reviews claims. Kyle and Hector are best friends. They are both 35, had similar upbringings, and ran a marathon together last year. Kyle is married while Hector is still single. When they applied to the same insurance company for life insurance, the company assigned Hector higher premiums, saying that an unmarried male was more likely to engage in risky activities and that there are health problems endemic to his ancestry. What would this practice be called? Unfair discrimination. Any discrimination in rates and premiums based on marital status, race, color, national origin, creed, or ancestry is illegal. Marshall just started his own business presenting elaborate fireworks displays. His clients will include amphitheaters and other concert locations, municipalities who sponsor Independence Day celebrations, and baseball and football stadiums. Marshall lives in Kansas and works in a 5-state area. He has his pyrotechnical license and a commercial driver's license with hazmat endorsement. He now needs professional liability insurance. Because of the unusual exposure and extreme risk associated with pyrotechnics, there are few insurance companies that will write this type of business. There are no authorized carriers in Marshall's state that will offer him professional liability coverage. A nationwide search shows that pyro insurance in Florida could provide that type of insurance. Even though pyro insurance is an unauthorized carrier for Kansas, it is on the list of the NAIC-approved surplus lines insurers. Therefore, Marshall's agent can work with pyro insurance to write the policy. Bill has purchased a family dwelling as an investment. He plans to rent the dwelling and use the rental income as a way of funding his retirement, after he has recovered the purchase cost of the dwelling. Bill also must insure the structure. Because it will not be owner-occupied, it will not qualify for homeowners coverage. This leaves Bill to choose coverage under a dwelling form. Bill realizes that with rental properties, there are times when a tenant will leave and the dwelling may be unoccupied for a period of time until another suitable tenant is found. If he insures under the dwelling form, there is a provision to suspend or limit certain coverages due to vacancy or unoccupancy for 60 or more consecutive days. If such a vacancy occurred, the rental house would not be covered for loss by burglary, glass breakage, or vandalism and malicious mischief.
Your insured, Tom Terrific, has a DP2 policy which provides up to $24,000 for coverages D and E. Tom and his family live in a nice 2-story house and rent out their basement apartment to a tenant for $300 a month. The insured sustains a fire loss which renders his home uninhabitable for 1 month. Tom and his family get a room at a hotel at a rate of $1,000 per month. Their increased cost of meals and their incurred expenses is $500 for the month. On the other hand, Tom is unable to collect his rental income for this month. The total loss from the fire would include loss of rental value, $300, coverage D. Additional living expenses, $1,500, coverage E. The total loss is $1,800. As mentioned earlier, Tom's coverage provides a total of $24,000, of which Tom can collect up to $2,000 in any 1 month. Since Tom's total loss for coverage D and coverage E combined is $1,800, he will recover the full amount.
Jessica loses one of her diamond earrings. When she reports the loss to her insurance company, she learns that they will not pay to replace the set. Because of the pair and set clause, the insurance company is only liable for the proportionate amount of the loss. If the pair of earrings has a value of $500, but a single earring is only worth $100, the policy will restore the lost value, or $400 in this case. JW owns 3 rental properties that are insured under dwelling policies. 2 of the dwellings are newer and are insured under a DP2 and a DP3 policy. The third dwelling is insured under a DP1 policy. When JW wanted to add the automatic increase in insurance endorsement, his insurer refused to add it to the DP1 policy. JW's agent explained that the purpose of the endorsement is to help meet the provisions of the replacement cost condition and protect against underinsurance, which might result from inflation and increasing construction costs. Because the DP1 pays on an actual cash value basis, any increase in the cost of construction is offset by the depreciation of the structure. Therefore, if the dwelling is insured to proper value, adding the endorsement could possibly result in overinsurance. Author Esteban Rey has a broad theft coverage endorsement in the policy on the apartment he owns, with both on- and off-premises coverage. When he leaves to work at his lakeside cabin, he takes his laptop with him. If the laptop is stolen while Esteban is sitting at a coffee shop checking his email, it would be covered under the off-premises coverage. If the laptop is stolen from the cabin while the author is boating at the lake, it would also be covered under the off-premises coverage. However, if the author leaves the laptop at the cabin when he returns to the city and the laptop is stolen, it would not be covered.